Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at GCT Semiconductor.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, it really helps us out. So let's just get right into this one because this is a wild situation.
It really is. I mean, imagine looking at your screen, right? And the algorithms are just screaming at you. The data says the company you're looking at is, well, fundamentally broken.
Oh, completely.
Like, they have a $615 million deficit. They're bleeding cash every single day. The auditors have actually slapped a formal warning on their filing saying, hey, they might be bankrupt within a year.
Yeah, a literal warning label on the company.
Right. But then, and this is the hook, you look over at the stock market, and the stock is up 112% this year. And the company's own executives, the people who actually see the bank accounts, they are buying every single share they can get their hands on.
It's the ultimate paradox. You have algorithmic logic screaming danger on one side and human desperation or maybe human foresight on the other.
Exactly. So who is lying? The AI or the humans? That's what we're going to figure out today. But before we get into the wealth building context of all this, I do want to mention the tool we're using to unpack this data.
Right. StockOracle.
Yeah, we're using StockOracle today. It's an AI-aided stock research platform. Now, a quick disclaimer, this is not financial advice, and it's not a trading signal service or real-time market data, okay?
Yeah, you always have to do your own research.
Exactly. We do have a special 14-day trial link below in the description. It is an affiliate link, so the channel may earn a commission at no extra cost to you if you use it.
And it's important to remember that StockOracle's AI insights and their valuation estimates, they can be incomplete or even just wrong.
Oh, for sure. You always have to verify the important facts yourself, but it's a great starting point for our analysis today. So let's talk about wealth building context for a second. Why are we even looking at a volatile, high-stakes, microcap turnaround story like GCT Semiconductor or ticker symbol GCTS?
Well, from a portfolio perspective, these are the kinds of asymmetrical bets that they really test your research skills.
Right. High risk, high reward.
Exactly. For you as an investor, managing wealth isn't just about buying massive blue chip stocks. It's about understanding how to evaluate distressed assets. Like, how do you separate a genuine tech turnaround from a financial sinking ship?
Especially when the data is screaming in both directions at the exact same time.
Yeah, it's incredibly noisy. To figure it out, we have to look past the surface-level numbers that usually trigger the trading algorithms.
Let's start with those surface numbers, though, because they are exactly what grabbed the headlines. We're looking at Q1 of 2026. GCTS reported net revenues of $1.9 million.
Which is a massive jump.
Yeah, a 287% increase year over year compared to the, $500,000 they did in the same quarter last year?
Right, and on a pure percentage basis, that looks like hypergrowth. It looks amazing.
And the supporting data looks pretty impressive, too. They finally transitioned from just developing their 5G chipset to actually shipping it commercially.
Those commercial shipments were up 58% sequentially.
Right, and their gross margins expanded, right, from a really weak 17% up to a pretty healthy 49.3%.
Yeah, because they're pushing higher margin service offerings alongside the hardware. And their operating expenses actually dropped by nearly 10%.
Down to $7.1 million. So, I mean, if you're just skimming a stock screener online, you see revenue tripling, shipments growing, margins expanding, and expenses dropping.
It looks perfect. It signals a company that figured out its unit economics and is just getting ready to scale to the moon.
But then there's always but here is where we have to dive into the fundamentals and unpack the brutal reality.
Oh, yeah, it's a bloodbath underneath.
It really is. You pull up the trailing 12-month metrics, the TTM, and the net margin is negative 1,078%.
Just let that sink in. Negative 1,000%.
Right. Even with all that Q1 5G shipment growth, their net loss for the first quarter was still $9.9 million.
Yeah.
So they brought in $1.9 million in revenue, but they burned almost $10 million to do it. I mean, it's like finding a $100 bill on the sidewalk, but you realize you borrowed $1,000 just to buy the metal detector to find it.
That is the perfect analogy.
Yep.
And to understand why that massive gap exists, you really have to look at how semiconductor manufacturing actually works.
It's not like software, right?
Not at all. The software, you write the code once, you debug it, and you can sell it infinitely with almost zero overhead.
Yeah.
But the semiconductor industry, it requires punishing, just relentless upfront capital.
You're spending years just designing the architecture of the chip.
Years of design, testing, validation, and then, sending prototypes to fabrication plants. And during that entire multi-year phase, your revenue from that product is mathematically zero.
Wow, zero.
Yeah, you are paying teams of highly specialized engineers. You're funding clean room testing, covering corporate overhead, all while money only flows outward.
So by the time you finally get a chip that works and you start shipping it commercially, you have dug this massive financial crater.
Precisely. And that's why their revenue jumped 287%. They're comparing current commercial shipments against a baseline of essentially nothing.
Oh, because they were in the development phase before.
Right. They are finally delivering products, which is a big deal,
Mhm.
but they are dragging this massive anchor of accumulated R&D costs behind them.
So the revenue is real, but it's basically a drop in the bucket compared to the cash burn required to actually sustain the business. Which means those headline earnings numbers are just a distraction. If they are burning almost $10 million a quarter, we have to look at the foundation. Like, what is keeping the lights on?
We have to look at the balance sheet.
Yeah. Let's frame this through the lens of a modern investor using an AI platform. Say you plug this into StockOracle to evaluate the asset. What does the AI see?
Well, let's lay out the raw data the AI is ingesting. As of March 31st, 2026, GCTS held exactly $7.2 million in cash and cash equivalents.
Say, hold on, 7.2 million in the bank, and they just lost 9.9 million in a single quarter?
Yeah, they are operating on fumes.
That's terrifying.
And it gets worse. Against that $7.2 million in cash, they have total liabilities of $96.3 million.
Oh my God.
Yeah, that includes $52.7 million in borrowings and $5 million in convertible notes. And they have an accumulated deficit of $615.3 million.
Okay, stop right there, because we really need to explain how that is mechanically possible. How does a company lose over $500 million over its lifetime and still have a ticker symbol on an exchange? Why didn't they go bankrupt years ago?
It's crazy, but that is the reality of hardware startups and biotech. They survive as what we call zombie companies.
Zombie companies. I like that.
Yeah, they just survive through iterative rounds of financing. You raise venture capital, you burn it to design a chip, you run out of money, so you go back to the markets and issue convertible debt.
Meaning investors loan you money, but they have the option to turn that debt into stock later.
Exactly. You promise them the next iteration of the chip will be the one that finally captures the market. So you burn that money, then you issue more shares, you take on high-interest loans.
You just keep kicking the can down the road.
Right. You just keep stacking obligations to keep the doors open, accumulating these massive losses on the balance sheet, hoping that one day the commercial revenue will actually outpace the debt.
Until the music stops.
And the music is definitely slowing down here.
Which brings us to the accounting reality. Because of that balance sheet, their auditors actually issued a going concern warning in their recent 10Q filing.
Yeah, and for anyone listening who is unfamiliar, a going concern warning isn't just a casual heads up.
No, it's a huge red flag.
It is a formal declaration
Yeah.
by an independent auditor stating there is substantial doubt this company can survive the next 12 months without going bankrupt.
The auditors basically look at the cash on hand, the burn rate, the debt coming due, and they just mathematically conclude the company will run out of money before the year is over, unless a miracle happens.
Exactly. So let's plug this back into the AI tool. StockOracle has this feature called OracleIQ, right?
Yeah, it acts like a digital appraiser. It reviews financial pillars like revenue growth and balance sheet health, and it gives you a color-coded dashboard of the stock.
I have to imagine OracleIQ looks at $7 million in cash versus nearly $100 million in debt and just flashes bright, blinding red.
Oh, it absolutely flags the solvency risk. The system is designed to catch exactly this kind of structural imbalance. But StockOracle also features a tool called OracleValue, which claims to calculate a stock's intrinsic value using 9 different models, including things like discounted net income and the discounted cash flow, or DCF model.
And this is where things get really tricky.
Yeah, because here is where I get a bit skeptical. I'm looking at their data, and GCTS has a price to sales, or PS ratio, of 54.7.
Wow.
Yeah. Before we even talk about the AI's models, can you break down that PS ratio for everyone? What does paying a 54 multiple actually mean for someone buying the stock today?
So a price to sales ratio tells you how much the market is valuing every single dollar of the company's revenue. A PS of 54.7 means that for every $1 GCTS generates in sales, investors are paying nearly $55 to own a piece of it.
That sounds incredibly high.
It is. For context, a healthy, mature tech company might trade at a PS of maybe 5 or 10. A ratio of a 54 means the stock is priced for absolute, flawless perfection. The market is expecting explosive future growth.
Okay, so they are massively overvalued relative to their current tiny revenue. They have deeply negative net margins and a going concern warning. Doesn't feeding this into a traditional discounted cash flow model just cause the AI to, like, short circuit?
Yeah, this is exactly where retail investors can get into trouble if they blindly trust algorithms.
Right.
A discounted cash flow model fundamentally works by estimating how much cash a company will generate in the future and then mathematically discounting that cash back to its value in today's dollars.
But they don't have any positive cash flow.
Right, so the AI has a massive problem. It has to pull standardized financial data, right? But if a company is losing money and facing bankruptcy, the AI either has to assume massive speculative future growth just to make the math work, or the model just breaks down entirely.
So the AI is essentially just hallucinating a best-case scenario to generate an intrinsic value score.
It's projecting based on trends. But in a binary survival situation, meaning the company either goes bankrupt or it doesn't discuss, mathematical trends are practically useless.
Yeah.
Now, tools like AI Stock Insights, they are incredible for organizing the narrative. They can instantly summarize the bull case and the bear case for you, but they cannot replace your obligation to verify the underlying mechanics yourself.
Especially since U.S. stock data on these platforms is typically delayed by 15 minutes anyway.
Exactly. An algorithm just cannot price in the human reality of a company running out of cash on a random Tuesday.
Okay, so the math is broken, the balance sheet is a disaster, and the AI models should theoretically be treating the stock like radioactive waste. That forces a massive question for our technical section.
Why is the stock performing so well?
Right. We are looking at a stock currently trading around $2.55. Now, that is down from a late May high of $3.93, but it is up dramatically from its January low of just under $1.
The year-to-date return is a massive 112.5%.
They even had a recent 5-day pop of over 26%. How is that happening?
You have to look under the hood of that price action. The trading volume right now is very low. It's only about half of its average volume.
Okay, and why does that matter to you as a trader?
Because low volume means it's a very thin market. When fewer shares are trading hands, it doesn't take much buying pressure to swing the price upward.
Oh, I see.
Yeah, that 26% pop wasn't necessarily driven by broad market conviction. It could just be a few players buying into an illiquid market. We also see a beta of 1.83.
Meaning for every 1% the broader market moves, this stock moves almost 2%.
Exactly. It is highly volatile and strategically vulnerable.
Which brings us to the sentiment and their competitive moat.
Yeah, they designed 5G and 4G LTE chipsets. That is an arena dominated by absolute apex predators. GCTS is trying to win contracts against Qualcomm, MediaTek, and Samsung.
If you run an AI moat analysis on this company, the tool is basically going to tell you they have a very narrow moat, right?
Essentially a puddle. They are trying to carve out a niche in specific telecom equipment, but they just lack a durable competitive advantage. I mean, the incumbents they are fighting spend more on R&D in a single afternoon than GCTS has in its entire corporate bank account.
Which creates an unbelievable paradox. You have a narrow moat against giants. You have a terrifying balance sheet. Media sentiment is totally split-like. Zacks is bullish on the revenue inflection, while Seeking Alpha is sitting at a really cautious hold.
Mixed signals everywhere.
Every algorithm is telling you this is a high-risk gamble, and yet the insiders are buying the stock.
And this is where the human element completely overrides the data.
Over the trailing 90 days, corporate insiders have purchased a net 55,554 shares. There have been 6 separate buy transactions and absolutely 0 sell transactions. The insider MSPR, the multi-factor sentiment price ratio, is a perfect 100.
That's significant.
But I have to push back here, though. Couldn't this just be a cheap PR stunt? Like, if a CEO drops 50 grand on their own stock, isn't that just a marketing expense to trick retail investors into thinking a turnaround is coming just so the stock price artificially inflates?
That is a very valid skepticism. And honestly, if it were one executive making a single highly publicized purchase, I would totally agree with you. It could just be optics. But the data shows something we call cluster buying.
Meaning multiple people are doing it at once.
Yes. When multiple insiders across the C-suite and the board are simultaneously buying shares on the open market with their own money and nobody is cashing out. That is a structural, constructive signal. It creates real speculative momentum.
Because they actually see the pipeline?
Exactly. These are the people sitting in the boardroom. They are looking at the unannounced customer contracts. They are talking to the lenders. They know the actual yield rates coming out of the fabrication plants.
They know something the data doesn't.
Right. And they are betting their own capital
Yeah.
that the upcoming catalysts are going to save the company.
Which means they believe they're going to pull off this tightrope walk. That leads us directly to the upcoming catalysts. Because the clock is ticking loudly. What mechanically needs to happen next for this company to actually survive?
It comes down to a collision between the next earnings report and the capital markets. Q2 2026 earnings are imminent, right in this August to September window. The absolute baseline requirement is that Q2 commercial revenue must exceed the 1.9 million they posted in Q1.
They have to prove the 5G shipment ramp wasn't just a one-time fluke.
They need to prove sustainable, accelerating demand. But let's say they hit it. Let's say they post 2.5 million in revenue. That is great for the headline, but it does not solve the fundamental problem.
Because their operating expenses are still over $7 million. They're still bleeding cash.
Which introduces the massive looming shadow over every current shareholder and brings us to the bear case and the real risks here. The dilution risk.
Oh, a dilution?
Yeah. To cover that shortfall and pay off their near-term debt, they need to raise capital. And they already have the mechanism in place to do it. They have a $200 million universal shelf registration filed with the SEC.
Okay, let's explain what that actually does to a retail investor who's holding the stock right now. A shelf registration is essentially the company getting pre-approval to create and sell brand new shares whenever they want.
Right.
I like to think of it like a bartender watering down the whiskey. The bar needs to make the bottle last longer to keep the doors open, so they pour water into it. The bar survives, but the person who paid for a glass of whiskey is left holding a much weaker drink. The value of their specific glass just evaporated.
That is exactly how equity dilution works. It waters down your ownership. And as part of that $200 million shelf, they have a $75 million ATM offering.
Okay, break that down. How does an ATM mechanically function?
So ATM stands for at the market. It basically allows the company to just drip feed new, freshly printed shares directly into the open market on a daily basis. They just sell them at the current market price to raise cash.
Just printing new shares and selling them.
Exactly. But look at the math here. The company's total market cap right now is only about 234.5 million. The stock is at 255. If they need to raise $50 million just to keep the lights on and restructure their debt, they have to flood the market with tens of millions of new shares.
Which actively suppresses the stock price while shrinking the ownership percentage of every single existing shareholder.
The ultimate irony here is that the survival of the company might be achieved at the direct expense of the current shareholders' equity value.
Wow. So the AI tools that offer custom watch lists with 400 different valuation metrics are essentially useless right now. GCTS isn't playing a game of subtle financial metrics. One missed earnings beat, one failed capital raise, and the whole thing collapses.
Yet, from an institutional analytical standpoint, a setup like this is generally given a rating 4.
A rating 4.
Yeah, a neutral, lower band stance. It is a highly binary, highly speculative situation. It is categorically not for conservative investors.
So what does the actual narrow path to survival look like for the bull case?
The bull case requires two massive dominoes to fall perfectly. First, they need 2 consecutive quarters of sequential revenue growth, pushing north of $3 million. If they hit $3 million at their current 49% gross margin, they finally start making a real dent in that operating expense.
It proves to the market that the core business model is actually viable.
Exactly. And the second domino, a formal SEC-filed debt refinancing announcement. They have to get that going concern warning removed from their filings.
That means sitting down with the lenders, holding that $52.7 million in borrowings, and convincing them to extend the maturity dates.
Right. If they can demonstrate operational growth on the product side and remove the immediate bankruptcy threat on the balance sheet side, the stock has real room to run.
And if they stumble?
The bear case is immediate and brutal. If the 5G shipments stall out, or if the lenders just refuse to extend the debt and force a default, the entire thesis is invalidated. In that scenario, the downside for equity holders is near total loss.
So it's time for the final verdict. Let's pull all of this together and look at what it means for you, the investor. We've journeyed through the anatomy of GCT Semiconductor today. It is a classic microcap battleground. On one side, you have explosive top-line growth and real commercial 5G rollout.
And on the other side, you have a terrifying balance sheet, less than 12 months of cash, and a going concern warning. It's the definition of diagnostic muddy waters.
And we looked at how you might use a platform like StockOracle to navigate this. These AI tools can instantly generate intrinsic value estimators. They can run moat analyses, track insider sentiment. They are incredible for organizing the chaos.
But the crucial takeaway for your long-term view is that these dashboards are starting points. They cannot do the critical thinking for you. When a company is facing extreme distress, algorithmic models based on historical trends or standardized cash flows simply break down.
They are not crystal balls. You still have to manually verify the mechanics of the debt, the dilution risk, and the reality of their market position. Which brings up a terrifying final thought for me.
What's that?
Right now, humans are the ones sitting across a boardroom table, begging human lenders for a debt extension based on a vision of a turnaround. But as tools like StockOracle evolve from passive research assistants to active automated portfolio managers, what happens in 5 or 10 years when an AI is the one deciding whether to approve that loan?
Oh, wow.
If cold, risk-averse algorithms take over the lending and survival side of the market, will volatile, messy turnaround stories like GCTS just go extinct entirely?
That's a great point. When the machines control the capital, human desperation might no longer be a valid collateral.
Something to think about the next time you look at a dashboard full of red warning lights. So again, our final rating here is a rating for neutral, lower band.
Definitely a speculative play.
If you found this analysis helpful, please remember to subscribe, like, and comment underneath. And don't forget to check out that 14-day trial link for StockOracle down in the description if you want to explore these AI tools for yourself.
Thanks for joining us, and we'll see you tomorrow for more stock analysis and catalysts.
Keep questioning the data, and we'll catch you next time.